Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial professionals John and Michael from Copper Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Copper Beech Financial Group. Michael, how are you today?
Oh, I'm good, Eric. How about yourself?
I'm doing fantastic. John, how are you?
I'm here. I'm doing great, Eric.
Oh, man.
How's the family? Everybody doing well?
Yeah, we're healthy. We're right in the middle of, I'm telling you, we're taking advantage of the market, guys. We're selling our house. And we've been working on it for like 6 months, and it's just ridiculous. There's always something else to do, all these things, all these other obligations that we have, and we like our friends and family and all that, but we're like, we really need to get this done. So we had the realtor over, and we finally said, okay, let's give ourselves a deadline, and it is steep. We said, okay, we'll be ready for pictures next Monday. So right at this point, recording this podcast, I have 5 days left to get this place ready.
Oh,
so
boy.
Yeah. It's going to be fun. Yeah, we're busy, but good.
And you have to talk to us for 40 minutes.
Oh, no, I don't have to. I want to. I know I'm going to learn something.
Good answer.
Yeah, good exactly. Please don't fire me. Yeah. No. So what are we talking about today, or what am I learning today? Let me ask you that.
Well, we're going to learn a little bit about estate taxes, and more specifically, how to pay for those estate taxes, or some options on how to pay for those estate taxes. And that's something that we often see in working with a lot of the families that we have on our platform, that they maybe don't necessarily think about, if they have an estate tax, how those taxes might be paid. And there's a few different options that your listeners, or our listeners, I should say, might want to consider or think about and talk with their advisors on. So that's what we're going to talk about today.
Yeah, and also we've talked in the past in other podcasts that we take the position that the estate tax is a voluntary tax. Now, technically, you have to pay it, but Uncle Sam gives you many different ways not to. So as strategists with our families, we always try to strategize and get that tax down to zero. We call it 5 levels of estate planning. Most people we come across do level 1 and level 2. They don't go down to level 5, which is zero tax planning. So we take our families through that. But to Michael's point, if there is an estate tax that's due and proper planning wasn't accomplished, we're going to walk through how that's paid for. And there's several options that we can look at. Some are good, some are not so good. So Michael will get into that today.
Yeah, and I think a lot of this boils down to the planning overall. And we've had some families, we'll get into this a little bit with the strategies, that have said, maybe I don't want to go through that 5 levels of estate planning. And that's really a personal or a family decision, because a lot of times to get to that 5th level of planning might require additional complexities that the family, for whatever reason, does not want to manage. It might involve a lot of different trusts. It might involve charitable planning and foundations and charitable trusts and some of the things that we've talked about on prior podcasts. And the family just might not want to go through all of that, and that's a viable solution. But you still have this question of, well, now you have an estate tax exposure to the next generation, so how do you as a family plan to pay for that? So again, that's what we're going to talk about today.
Well, let me ask you a question before we get started, because I've heard a lot within the news, I've heard it on the radio, and we know, because of how much money has been poured into the economy, that Uncle Sam wants his money. He wants his money back. I've heard a lot about the IRS being very aggressive when it comes to taxes, meaning like income taxes. Do you see that on the horizon are they going to get more aggressive towards estate tax and making sure that people are paying their fair share kind of thing?
I would say, well, certainly, again, if you've listened to some prior podcasts going back to last year, there was a lot of conversation with some of the tax provisions and bills that Congress was floating around. There is a lot of support for making the estate tax have more of a bite to kind of echo your point there, Eric, and whether it's fair share or however you want to define it, but there are certainly lawmakers out there that want to make this a more serious tax. It is a tax right now that does not, if you look at today, affect the vast majority of people in the United States, but that doesn't mean that they can't change it. And we'll get into a little bit on the exemption amount, which is the threshold for when this tax does kick in. But yeah, I think last 100 years, there's maybe only been a couple years where there hasn't been an estate tax. So it's definitely something that is out there and probably will stay in one degree or another.
Yeah, if you listen to the conversations out there, they're kind of funny, but the one side of the equation, I won't say if it's Republican or Democrats, are pitching the fact that they now want to tax billionaires, not millionaires. And you have to ask the question, well, why'd they change that dialogue? Because most of the senators and congressmen are now millionaires. Mm-hmm. And they're pushing the billionaire tax. So you see some trends in the political arena that's pushing now the burden tax to billionaires on the income tax side and obviously on the estate tax side. But as I said, the income tax side is a little bit harder to manage, only because, remember, the tax code was put in place for business owners, not for W-2 employees. I have that conversation all the time with some of our clients. And it's always a challenge that if someone's making $1 million a year, an executive of IBM, as an example, he's limited in how he could shelter some of those taxes. Obviously, he has 401k plans, but you're capped at $25,000 or $26,000 now, and you're limited, so you pay a lot of tax. Now, there are some strategies on the charitable side that we take advantage of, but it's harder to manage the income tax. As you're a business owner, you made $1 million, there's a lot of deductions you can take. So we're always going back and forth between the 40% estate tax or the 35 to 40% income tax challenge. And that's really the world we live in.
Mm-hmm. Yep. All right, so let's get into a little bit let's start again with that threshold I talked about, the exemption amount for when this federal estate tax kicks in. And by the way, just as we're not going to cover this, I don't think as much today, but depending on where you live, there are certain states that have their own estate tax or inheritance tax, so you should be aware of what that is. There's really a handful of states. Massachusetts is one, right? Yeah, Massachusetts. We live in New Jersey. For a long time, we had a state estate tax. We don't anymore. Probably about 10 years ago, that was eliminated. So just be aware of that, because you might not be at the federal level of where the federal tax kicks in, but you might have a state tax or inheritance tax that you should be aware of. But we're going to talk about the federal tax today. And as we're recording this, the exemption amount is really right around $12 million per person. And spouses, if you're married, you can essentially use each of your exemptions to combine them together. So really, we're going to use the term 24 million roughly of exemption amount or of net worth, that if you pass that on to your heirs, usually descendants, that is the threshold for when the estate tax kicks in. And if you're above that amount and you pass on assets to your heirs, there is a 40% tax on any excess above that $24 million. So again, this is not a tax that affects the average American, but for a lot of the families that we work with, probably a lot of families that are listening to this podcast, that might be more of an issue and of a concern. Maybe not today, but in the future, which gets back to a lot of the planning that we do and that you should be working with your advisors on, is because you might not have that tax today, but if you factor in certain growth and assumptions, you might have that in the future to be concerned about. So that's the threshold today. Now, about in 2026, so in a few years from now, that exemption amount is going to be cut in half per person. So it's going to drop down to about $6 million per person plus inflation. So in quite a few years, just a few years from now, there are very likely going to be more people subjected to that estate tax than currently exists today. So that's another thing that you should be aware of when looking at your planning.
And the theme we're addressing now with all our clients and people we discuss this issue with is that it's like you use it or you lose it.
So just to be more specific, you have $24 million right now that you can gift to your heirs without paying estate tax. $12 million of that is going to go away in 2026. So after 2026, you're only going to have $12 million that you can gift to heirs before the estate tax kicks in. So this use it or lose it type situation is really for the $12 million that will go away under current law in 2026. So hopefully that maybe gives a little bit of clarity if that was confusing to anybody.
That's a little confusing.
But you have essentially next couple of years, you have $12 million that is projected to be lost from a gifting standpoint. So it's important that families out there consider that if this is something that is applicable to you, this federal estate tax, that you look at that now and you talk to your advisors about how to best use that going forward before it's lost.
Now let's start discussing that. Let's assume for a moment you have this tax and you suddenly accidentally passed away and the tax is due to the next generation. How do you pay for those taxes? So Michael, why don't we go through some of the IRS rules around how that could be funded, and let's talk about that, and then we can talk about some other options.
Yep. So generally speaking, the tax is due within 9 months of the death of the person who passed away. And the IRS and Congress put it in place that they really only accept cash. So you have to have cash. They accept that tax in cash. They don't accept it in illiquid real estate or land or business assets. They need cash, which gets back to the question we're going to talk about today, which is how is that tax paid for? So if you don't have that amount in cash, do you liquidate assets to pay for that tax? That's the worst case scenario. We've unfortunately seen certain estates and have heard stories of certain estates that haven't had enough liquidity and they have been forced to liquidate assets within 9 months to be able to pay for that tax. And depending on that asset, it could be a fire sale, right? If you only have 9 months to sell a piece of real estate, maybe in today's market that would be easier to do just with where we are real estate wise, but it might not always be the easiest thing to sell a piece of real estate in 9 months and get the value that you would otherwise get. So you'd have to then be forced to lower the sales price to get that liquidity, and that results in lost assets going to the next generation. So that's when we say how to pay for the tax, that's usually option one, which is usually the worst case scenario. Now, fortunately,
let me jump in there real quick, because
Sure.
Is there a provision, I guess, or any type of exemption for farmland? Because I've heard horror stories. There was actually one out of Denver where a family had, I believe, 600 acres. It was very, very close to Denver. And when the other parent, I guess it was the second to die, passed away, there was a huge estate tax due because of the property. And they had to either sell a large chunk of their family farm to pay an estate tax, so they lose their farm, right? I mean, they lose a lot of their farm. Yep. Or there was something where I couldn't remember, there was some sort of deal that they had to sign where they could never sell the property for development. And so again, they're losing out. Have you heard something like that? Are there loopholes, quote unquote, that people can use in that system?
Yes. And that gets to the second option, which is really was put in the law really to address the issue you brought up, Eric, which is Section 6166 of the tax code. And it really applies to business owners and families that own closely held business stock. And that could include a farm, that could be a manufacturing business. It doesn't really matter the type of business. But if you own a closely held business, there is an exemption that Congress put in place to allow you the flexibility to not have to liquidate that business in order to pay the tax. And that is what 6166 was put in law to cover. And that's a very complicated section. That's really, the details of that are beyond the scope of today's conversation. In fact, that'd probably be a good podcast just to dig in specifically on all the nuances there. But again, it only applies if you own a closely held business, and your business has to be more than 35% of your net worth in order to qualify. So if it's less than 35%, you can't use this section. But what this section will allow you to do is to defer the payment of estate taxes up to 14 years typically. So that is a provision that Congress put in place, again, to mitigate that scenario that you just outlined, Eric, where the family was forced to sell their farm maybe to pay the taxes. And again, I don't know the particulars maybe of that particular family. Maybe 6166 did not apply for one reason or another, or maybe they were not aware of it. But that is a provision that's in place to really help that.
Yeah, and how it works, Michael, you get into the interest rate that the IRS assumes and the liens against the company. Why don't you discuss that a little bit?
Yeah, when we look at planning, a lot of times 6166 gets brought up in conversations, and from our experience, it's usually a last resort way to help pay for estate taxes, so you don't have to do that fire sale, or you don't have to liquidate business or other personal assets, because there are some drawbacks to this. There's an interest rate that's assumed, so you do have to pay interest on the tax that is deferred. So really, if you think about that, you're paying the tax that you otherwise owe plus interest, so you end up really paying more in taxes over that 14-year period of time. And there are some other provisions under this Section 6166 that can be a negative to the estate and to the family. I.e., there could be a tax lien on the estate. There are certain provisions that may require that the estate buy a surety bond, which is really, in essence, an insurance policy to make sure that that tax is paid over time. It's very onerous and it's very costly, really, for an estate to really elect 6166, which is why when we outline this provision to a lot of our families, when we're going through this discussion about how to pay this estate tax, pretty much 9 times out of 10, the family does not want to rely on that as a solution to help pay their tax because of a lot of these onerous provisions that go into it. I mean, think about a family business that maybe has the next generation taking over the business. They certainly don't want to have this tax lien and some of these surety bonds sort of over their heads, preventing them from maybe doing or managing the business the way that they would otherwise want to manage.
And don't miss a payment.
Right. Yeah. So that is an option, right? I think it's better than the first option, which is you have to sell the business assets in order to pay the tax. So it certainly has its benefits for those families that maybe didn't do planning during their lifetime, and now the next generation is left with having to do something in order to pay that tax. Dad, why don't you outline maybe our approach, which is maybe doing more of the advanced planning up front to how to reduce that tax as best you can as a way. And that's what gets back to the complexity of what the family wants to really do. But maybe you outlined it before, but I would maybe just detail a little bit if you don't mind.
Yeah, it involves 4 or 5 different steps in planning. And obviously we've talked in the past about setting up certain trusts. Like, for example, what we typically do with a larger estate to try to reduce the tax going forward is do a sale to a trust of an asset. So let's assume, Eric, you own a business that you want to get into a trust. You can get that business valued, but the way it's valued is Uncle Sam allows you to get a discount if you do a recap of the stock. I won't get into the weeds, but basically you convert voting shares to non-voting shares, 99% non-voting shares, 1% voting share. You want to maintain control, and you sell the non-voting shares to a trust. That kind of freezes the value of the estate. So going forward, if it's owned in a trust, it's never going to be taxed again as long as it stays in that trust. So there's some techniques we use from estate planning trust designs. There's also some charitable planning we look at. And again, you go back to our previous podcast, a lot of those topics are well covered in detail. One asset class that people misunderstand sometimes is life insurance. Again, Michael mentioned complexity before, that some families just don't want to go through all those jumps and hoops to get their tax down to zero. I've had families in the past say to me, you know what, John, if I owe $5-10 million in taxes, why don't we just buy a life insurance policy and leverage that tax when it's due and use a trust to own that policy? And that's a very viable way to look at it. However, you're still paying the tax, Eric. You're still paying the tax, and it's just leverage. Mm-hmm. So life insurance we find to be a key asset class that allows you to leverage that tax. If there's no other option you don't want to consider another option, or you don't want to be that complex. So a lot of our clients look at a combination of all the things I just discussed as a plan to eliminate that tax or pay for that tax going forward.
Yeah, I think that's really important, is to look at all of these options. Very often for a lot of families, you're doing what you can with trying to reduce the estate and lower the tax as best you can up front. And then you might look at maybe buying life insurance to fund the difference. If you don't want to do those zero tax planning, like incorporate charities into the conversation, that just might not be an objective of the family. That's when you start looking at life insurance. That's when you might start looking at, okay, if we don't want to buy as much life insurance, maybe we'll do a partial 6166 election, which you can do. You don't have to elect 6166 for the maximum amount that you're allowed to defer. So there's a lot of different ways that you can design this. But I think, again, the purpose of today's podcast was really, hopefully, if you're out there and you might have this exposure, just to start thinking about how that's going to be paid. Because again, hopefully everybody lives to 100 and you don't have to worry about this for a very long period of time. But as we all know, that's not how life works sometimes. So sometimes you want to make sure that you're planning for this eventuality now and make sure that it's set in stone, or at least you have some strategy that your family can use to help develop a plan about how this tax is going to be paid.
And Michael earlier said something that I think is extremely important. When we first meet any family, we spend a lot of time doing an audit and going through their values in their estate and do projections. Those projections often surprise the heck out of our families because they're not thinking 20, 30 years from now. Because if you think of an average lifespan, I think it's 83 now. I don't know what the exact number is. I think COVID twisted that a little bit. But let's say it's 80 for a number. So the average person is going to live to age 80. So if you're 40 years old, that's 40 years of compounding growth of an asset that you own. So you could have a large estate problem when you're supposed to pass away at age 80. The odds you pass away at age 40 are minimal, but you have to plan for the future. So when we crunch our numbers, people might not have a tax today, but they have it 40 years from now. How do you circumvent that? How do you do planning to prevent that? And that's where these trusts get involved, and that's where we take a look at leveraging things accordingly to get that tax down to zero. So it's critical that anybody's listening to this podcast, if you don't have that number on a projection, you should go back to your advisors and say, listen, project out my estate and let me know what that's going to look like when I'm supposed to pass away, me and my wife. And it's the rule of 72. I think we talked about that before, Eric. Mm-hmm. If you just take the number 72, divide it by a growth rate, you're assuming your estate's going to grow at, let's say, 10%. You divide 10 by 72, and every 7.2 years, your asset base will double in value. So if you're worth $1 million today, 7.2 years, you're going to be worth 2. 7.2 years, you're worth 4, and so on and so forth. So when you look at the natural compounding of assets, even at reasonable interest rates, you're going to have a large estate somewhere down the road, unless you pay attention to it.
Yeah, and that's why you just mentioned it, Dad. Starting earlier is better. So these projections can be helpful because we've really been involved in a lot of conversations, whether it's with a client or attorney or other advisor, and they've said, we don't have an estate tax issue today, so there's really no need to really have these conversations, but they are not, again, looking necessarily into the future and maybe some of the proactive steps that they could take now to help mitigate that tax in the future, because if we use those reasonable growth rates that you just mentioned, there will be one. Again, we can't predict where tax laws are going to go. I mean, Congress can get rid of the estate tax tomorrow. I think that's probably an unlikely event, but there's a whole host of things that could happen, but we try to be as proactive and design things as flexibly just to take advantage of that.
Yeah, one of the things we didn't talk earlier about annual gift exclusions. We forgot to mention that. You can gift, each mom and dad, parents can gift each one of their kids, nieces, nephews, friends, neighbors. We often tell a client they can gift to us as well. But anyway, you can give up to $15,000. Is it $15,000 or $15,000 still? I thought they were going to up it this year, but $15,000 per child. So if you have 2 children, both you and your wife could give $30,000 apiece to those children, and they could gift to a trust that's going to be out of their taxable estate. But often when you look at the growth of assets, even though you're gifting $60,000 a year, you might be wealthy enough where your assets are growing more than that. So it's kind of a wash, but you still have that option to make those annual gifts. I got 4 grandkids, and we're doing that now with our planning. We're going to gift directly to the grandkids, and that's part of the equation.
Excuse me, I just wanted to clarify. It is $16,000 this year.
I thought it was $16,000.
Yep, $16,000 per person per year. Yep.
Good. So anyway, these are some of the ideas and challenges that a lot of our families need to address. And quite often we see families wait too long. And I know we've said that in the past on podcasts. It's not too early to get planning done. I mean, we're starting to work with some younger families in their 30s and 40s because if they do it right now, we could save them millions of dollars in taxes for their kids. But at least they're smart enough to take advantage of doing things early, but it's hard to get young people to do anything early. Right, Eric?
Absolutely.
It's a challenge, especially younger entrepreneurs. They're like cowboys. They can't pay attention to, they want to grow, and they don't take time out to do some planning. But fortunately, we work with some younger families that have adopted that philosophy and do some advanced planning.
Yeah, it's great to see. I'm going to talk about one other option that's really developed over the last probably 10 years or so, and there was a court case around 10 years ago that came out that really made this strategy sort of blessed by at least the courts. And that's it's called the estate of Gregan is the case, and now it's commonly termed as a Gregan loan. And what that is really, again, from the standpoint of trying to pay for estate taxes is on your estate tax return, you are allowed to deduct certain administrative expenses from your gross estate off of that number. So you can deduct things like legal fees and some other expenses that will help reduce your estate when they calculate that tax. What this Gregan loan is a situation where an estate maybe is illiquid, so doesn't have a lot of liquidity to pay for that tax. And what happened in this case was the estate went out and borrowed money from a bank. They had illiquid business assets and they didn't want to liquidate. So similar to a 6166 conversation, they didn't want to really liquidate their business, but they went out and they borrowed money from a bank. And they were able to deduct the full interest payments over that loan period of time. So let's say it's a 15-year loan, and there would be certain interest rates and certain interest that would have to be paid over that 15-year period of time. And they structured that loan in a very particular way to make sure that that interest obligation was definite, essentially. And what the taxpayer was allowed to do in that case was actually deduct off of their estate tax return the full amount of the interest that would be paid over that 15 years, all in the first year. So think of it like an accelerated depreciation in effect against their estate. And that has the effect of reducing the estate by that interest obligation, which helps lower the tax. Now, you're still borrowing money. In that case, I believe they borrowed it from a third-party bank. So, you still have to pay that loan back. But where I think there could be some creativity with that type of loan is pairing that with something like a life insurance policy owned in an ILIT. It stands for Irrevocable Life Insurance Trust, by the way. Many of you have probably heard of that acronym. ILIT is the term that's used. So the ILIT can purchase a life insurance policy, and the estate, when the taxpayers pass away, can borrow funds from that, the death benefit proceeds from that life insurance policy, to satisfy this Gregan loan interest deduction, as long as that loan is structured properly. And again, that's probably beyond the scope of today's conversation, but there are very specific terms that you have to have in that loan. That there can't be any prepayments of that loan allowed, because if you think about it conceptually, that makes sense. Is if you are telling the IRS you're going to deduct the full interest over that loan, they don't want you to be able to prepay the loan in year 3, right? And not pay the full interest. So there's all these little nuances that, again, having a qualified attorney and an advisor team to make sure that they know how to structure that is really important. But that's another way that particularly illiquid estates are trying to find ways to pay for estate taxes without having to resort to that first option we talked about, which is liquidating illiquid assets at a fire sale. So there's a lot of creativity that's being developed to be able to help with this. And again, you can use a lot of these different strategies together. So you might want to use a Gregan loan for part of it, but also have advanced estate planning to reduce the tax down as best you can, pairing that with life insurance. So you're using a little bit of all of these strategies to find a plan that fits best for the family. And that's really what's most important.
Yeah, the client years ago, Eric, that had, I think it was a $15 million estate tax bill upon his passing.
Wow.
He was also very charitably inclined. So he said to me one day, he says, all right, so this zero tax plan that you're talking to me about, John, I could give my $15 million or $30 million, I think it was a $30 million estate to charity, right? I said, yeah, you can. And that'll give me like no tax, right? I said, right. So if I bought a life insurance policy in that ILIT you're talking about, I could refund that back to my children, correct? Tax-free, correct? I said, yes. So Uncle Sam lost, charity won, and my kids got my full estate. That's how simple you can get. That was one gentleman who thought it through, and I don't want the complexity. I just want to make sure I take care of my charities, and my kids get what I gave the charity, and I cut Uncle Sam out. So you can get real specific, but that's how simple it is sometimes.
Yeah.
Wow.
Yeah.
Powerful.
Yeah, good stuff. I think that's all we had today, Eric. I think you can, to Michael's point, we can dig into any one of these topics deeply and get very specific. But I hope I gave our audience a view on if you have a tax to be paid, you have to think carefully how you approach that.
Yep, I think it's just it sounds cliche, but knowledge is power. And I think knowledge of this situation is helpful for any family just to understand it. And whatever solution the family decides is, of course, up to them. But I think it's always important to go into this without any surprises, and that's planning. is at least knowing what options you have and what the ramifications of any decisions you make might be.
And start now. Don't wait to do that projection.
Well, and that's the point, is that the nice thing is that you can't do the planning when you're dead. You can't do the planning then.
Exactly.
You need to do it as soon as possible. And life gets busy. We all understand that. But we don't want people avoiding this, right? I mean, avoiding it because they think it's going to be complex. Like you said earlier, it doesn't have to be, it sounds like. And to Michael's point, Michael, you said you need to really find a qualified attorney and financial team. I happen to know a qualified attorney and financial team. I'm talking to him right now. So for those that are listening and saying, okay, this is something, it may be kind of like pulling some teeth or whatever, but I do need to get my spouse and we need to sit down and have this conversation so we can protect our estate for our children and grandchildren, great-grandchildren, so on and so forth. What's the best way to hook up with you guys, to contact you and get this information or talk through their specific situation?
Well, you can always call us on the phone, area code 856-988-8300. We're, of course, on social media. We're on LinkedIn. You can find Copper Beech's page, my page, my father's page. You can always message us on there. You can also reach our website. It's www.cbfgllc.com. And I guess you could always write us a letter too, but that might, I don't know if that's really used a lot these days. I don't know if we need to give you our address. It's on our website. Go to our website first and then find our address, and then you could send us a letter if you want.
Lots of ways to contact you.
Yeah.
All right, gentlemen, always a pleasure. Thank you so much for your time today.
Thanks,
Thank you, Eric.
You bet. But our last thank you always goes to you, listening audience. Thank you so much for tuning in and listening to the Truth About Wealth podcast with John and Michael Parise. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when John and Michael come out with a new podcast, it'll show up directly on your listening device. This makes it really easy to share these podcasts with your friends and family. And for those that are thinking, you know what, I want to do some planning, we need to maybe have this conversation. Maybe you have a spouse that would want to drag their feet a little bit. Share this podcast with them. Have them listen to it and have them listen to the intentions of these two guys and what they do with their families. It's fantastic. Again, thank you so much for listening today. For everyone at Copper Beech Financial Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Copper Beech Financial Group. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
This material is for informational purposes only. Neither APFS nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Copper Beech is not affiliated with American Portfolios Financial Services, Inc. and American Portfolios Advisors, Inc. Securities offered through American Portfolio Financial Services, Inc., a member of FINRA SIPC, investment advisory and financial planning services offered through American Portfolio Advisors, Inc., an SCC registered investment advisor. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors. Copper Beech is an unaffiliated entity of American Portfolios Financial Services, Inc. and American Portfolios Advisors, Inc. Any opinion expressed in this forum is not the opinions of American Portfolio Financial Services, Inc. and American Portfolio Advisors, Inc. and have not been reviewed by the firm for completeness or accuracy.